NYCERS investment meeting for July 28, 2015. It is now, what time is it? 9:46, and I'll have the executive director call the roll.
Chair.
Here.
Controller's office. Here. Manager's office. Here. Borough President Manhattan.
Here.
Borough President Brooklyn. Borough President Queens. Borough President Staten Island.
Here.
Borough President Bronx. International Brotherhood of Teamsters.
Here.
Transport Workers Union.
Here.
District Council 37.
Presente.
You have a quorum.
Perfect. So, the Chief Executive Officer, Chief Investment Officer, take it away.
Thanks very much, Antonio. Briefly, because we have an extra agenda item, I'm going to cover the highlights for May. It's in the flip book, which you have in front of you. If you don't, John Dorsett can get you copies. You turn to page 25. You can see what's been going on in the global equity markets, which is a good place to start to sort of set the stage. This is a look at returns over the past year. You can see it's been a consistent positive movement through mid-July for the U.S. equity market with some ups and downs, but the U.S. equity market is in white. The developed international markets and emerging markets, developed in orange and emerging in yellow, have been struggling for much of the past year and had fought their way back to flat at the beginning of May. We'll be looking at the May month in this report. And in the month of May, you can see emerging markets beginning to crack. There was weakness in China in particular, concerns about economic weakness, and then continuing deterioration in the condition of their China A-shares market, which was beginning to present itself in May. Europe held in there for most of May. It's down a little bit. And then Europe, subsequent to the period we're going to look at today, went through all the concerns about Greece. Then there was a relief rally through the middle of July. That's when this snapshot was taken. As you all know, since this snapshot was taken, the markets have begun to sell off again, particularly China, which has been extraordinarily weak. And one of the trustees asked if I'd comment on that a little bit. The prognosticators, the folks who come on TV, don't seem to be too worried about that. Why is that? It looks like China's fallen apart from the looks of its stock market. You have to understand, I think, at the core that the stock market in China is a very, very small part of things. It's a very young market, a lot of retail investors, a lot of state-owned companies whose shares are being traded, and it is very small relative to the size of China and China's economy. The other thing to realize is that the involvement of the state, of the Chinese government, is huge. So this morning it was announced that local governments will be buying stocks today, and so there's just all this machinery to come in and interfere with the markets, which clouds the picture. But the bottom line is that you have a lot of retail investors that got very excited. They started buying stocks on margin. Really amazing in a country where they buy almost nothing on margin. Individual people, they tend to have huge savings. But they were buying stocks on margin. And we've seen this movie before throughout many markets, throughout many years, when things turn and everybody's bought stocks on margin and the stocks start going down, they start panicking and selling. That's what's been happening, and it's been elongated by the fact that the Chinese authorities are restricting the movement of stocks in any one day, and so it's like watching a slow motion train crash. But even if the Chinese government is not able to fully control this market, which everybody believes they'll be able to do, it's small relative to the size of the economy. It's unlikely to bleed into, sort of a worldwide problem. The most close market to it, where you have a lot of the same actors, trying to participate in larger amounts in a real market that has much bigger flows and is a much larger impact. Watch the Hong Kong market. That market has not been terribly strong either. It's been down in sympathy, as has many emerging markets. But that's the one to look at as being a more substantial market and more indicative of some of the underlying economic activity over there. So with that commentary out of the way, let me move on to the results for May. Flip to the next page. It's 27. Oh, I guess the number is underneath State Street there in the top. You can see in May, it was an up market, 1 to 2% for the U.S. markets. IFA, which is the developed international markets, Europe and Japan, was down 0.5%. The emerging market universe is down 4%. So it was, as you can see from the picture before, it was a weak month for emerging markets. And you can see that it was modestly negative for bonds as interest rates continue to creep up, now approaching the mid-2s. It's 230 something change. That's about all I have to show on that page. The next page, we're not going to go through the details of June, but we always give you a snapshot this late in the month. You can see what happened in June with the Russell indices down almost 2%, IFA down almost 3%, and whereas the emerging market funds also down 2.5% during the period. So June was an ugly month. When I come back to you in June, the numbers are going to be negative for the month. Page 31 shows you the mix. You can see that we had positive results during June from the U.S. equities. It added 44 basis points to the portfolio. The developed equity took 7 off. The emerging equity took 26 off. Remember, the emerging is much smaller than the U.S. equity, so it has, even though it's down more, it has a less pronounced effect. 4 plus 5, down 6 basis points as interest rates go up. And you can see that the dark one there, 0.20, is private equity, which was up with the U.S. market. What's our positioning during this period of time? I say the same thing every month. It doesn't change month to month, and I'll be saying the same thing for the next couple months until interest rates resume more normal relationships. We're equal to our asset allocation among the various equity sleeves. If you look on the left side, you can see everything's pretty close to zero. U.S. equities, international equities, emerging equities, etc. We're underweight long-term bonds in blue and inflation-linked bonds in purple, and overweight short-term bonds in gray, bonds less than 5 years. When you take the gray and the blue and mush them together, it looks just like the Barclays Aggregate Index. So although we're underweight long-term bonds, the combination of these two basically neutralizes for our usual tilt towards long-term bonds. We're now neutral because in a rising interest rate environment, long-term bonds will suffer greater reactions to interest rate changes. Flipping a couple pages to page 40, I'm sorry, page 39, third column from the left. If you go down to the bottom, you can see the total results for the month. NYCERS total portfolio is up 36 basis points. This is, again, gross of public market fees, net of private market fees, and the benchmark was up 53 basis points. So we trailed by 17 basis points. A couple of columns over, you can see that we trail by 61 basis points for the fiscal year through May. When we come back to you the next quarter, as we showed you in the March quarter, we'll have the returns net of all fees, and we'll be introducing a new report that's going to show you everything net of fees that we plan to keep in the quarters to come. We've taken your inputs on it, and so we'll be rolling that out in September when we go through the main numbers. We'll leave the detailed questions on managers and so forth for the executive session, but I'm happy to take any questions, Mr. Chairman, and or if not, we can move on.
Any questions?
Okay.
All right. We have the diversity initiative.
Yeah, Jimmy Ann, Jimmy can come down here. Jimmy Ann is going to update you on our diversity initiative.
Hi, so my name is Jimmy Yan. For those who haven't met me, I'm Special Counsel in the Bureau of Asset Management, and I've been working on the diversity initiative, which this board approved a little while ago, and wanted to give you a basic update on it. It's closing in on being we're closing in on a final draft, and as you recall, the gist of this initiative is to ask prospective and current investment managers about the diversity of their investment professional makeup. So we're, even though it's fairly simple, we've been working on drafting the basic survey tool, which will ask managers about the racial and gender diversity of their investment professionals. We're using categories that are the same as what the Equal Employment Opportunity Commission, the EOC, asked for in their EO1 report. We would be asking that, about their investment professionals, which are defined as the people who are really involved in some way in investment decision making, as opposed to all employees at the management firm. We would also ask a set of questions about the existence of policies and procedures that ensure diversity and inclusion at the management firms, including, do you have policies and procedures? Do you have policies and procedures around supplier diversity? Do you have efforts around intervening in the pipeline, creating a more diverse pipeline? What's your history of do you have any bad history in terms of discrimination? And do you have systems and policies of accountability to ensure that your policies are being followed, and do you have ways of measuring that progress? So those are the core of this initiative is pretty basic, getting at the composition of the managers. And so we would ask that of prospective managers and existing ones, and we ask about policies to try to make sure that there's something in place to make keep current and future diversity sustainable and possible. So we are just want to give you that update. We're closing in on it, and we'll share with you the draft when it's done and get further input from you soon.
Any questions? Rio.
How do you assess the value of the responses? So the presumption is that if you have a yes or no answer, you have a policy. For diversity, I would assume some policies are better than others. Are you reviewing those as well?
We're planning to say, if do you have a policy for this, for diversity and inclusion, et cetera? And say, if yes, please provide it to us. So we plan. Our intent is to ask for any policies that they have on that area, and then we'll assess how those look, based on general standards that are out there, or they're relative to one another. Perhaps we can get ideas from those submissions about best practices that we can encourage in the future as well.
Just to follow up, in addition to the policy, the written policy, is there a desire to find out the makeup of the boards of these individual entities are?
Yes, we also intend to ask about the diversity, racial and gender diversity of the boards of directors, and also the investment professionals, and also for compensation. So the percentage breakdown of the diversity breakdown for their compensation and profit sharing in the firm. So those would be three categories of diversity that we'd be
hiring practices, promotion practices, retention practices, training practices, mentoring practices and/or practices and/or what colleges they reach out to?
Most of those we are planning to ask about. When we asked about their policies around diversity and inclusion, we were planning to include a list of the different areas of employment policy that applies to, including retention, promotion, hiring, recruiting. So most of those things, I'm not sure that we've thought about asking specifically about what colleges, but we would certainly ask for a copy of their outreach and recruiting plan, which would describe, probably describe the way that they reach out to colleges.
Thank you.
Yeah,
Is this policy in effect now, or it's going into effect?
It's not yet in effect. That's why we're giving you the update. We're going to bring it to you before it's implemented.
It'll go into effect with our next procurement. That's our intention, is to put it in place with all procurements going forward.
Jimmy, the Vendex forms that the vendors fill out, does that capture any data as to EEOC complaints, filings by anyone in terms of discriminatory litigation, or anything that also would be utilized for purposes?
That I'm not too sure whether Vendex asked about. It probably does ask about that certain litigation history like that. We can see whether we can access information about them. Certainly to the extent that ask for information is not being, that's separate from BAM and the systems, and it's certainly not being considered by the systems in BAM. So we can confirm what information Vendex asks and whether we could utilize that information somehow. That's
I was going to say, the questionnaire actually does ask about if there's been any sort of administrative filings, findings, that kind of stuff, and also too, if the company is subject to SEC filings, the vendors normally give their 10Ks. FYI.
so just to follow up with something that was said before, part of our procurement, I've asked this question, whether in fact you have to follow proper procurement policy in the DPP for those that you enter into contract. One of the requirements is on the Executive Order 50, requires the kind of data that was mentioned before regarding the makeup of any institution that enters into a contract with New York that has more than 50 employees. It's required to provide that data as part of the procurement policy. It's not a Vendex requirement, but it is a PPP requirement. Unless a waiver is issued, which is usually issued by the Department of Small Business Services. And so I've asked this question before, whether in fact that's something that those of you enter into a contract with have to comply with this.
Yeah, so I heard that question was raised, and I did a little research into it. I'm sorry I didn't anticipate it would come up, but when I looked into it, and others who might know about it can chime in, is that's an executive order that requires potential vendors or vendors to state that they have policies in place and are complying with equal employment opportunity policies and principles, and with anti-discrimination requirements. And I believe that's submitted to I can't remember, it might be submitted to a central agency, or I forget if it's submitted to different agencies, but it asks just about compliance with laws. So what we're doing, so it doesn't include what we're doing, which is asking about the diversity composition of their staff, and as well as the extent of their policies around diversity.
Actually, Section C of that order requires employment reports, which identify whether the fact the company has been raised in things. So you may want to look into this. Because
Yeah,
the order itself, and I've seen this in the procurement, has employment information about makeup of the employees, and whether in fact, because of the liability issue, there have been any kind of discriminatory lawsuits on the EEOC that was asked before.
okay, thanks, yeah.
Would you mind looking into?
Definitely, we'll confirm, and when we reach out to you about the survey tool, we'll include a note to try to confirm our view of what that means, and see how that affects what we're doing. But certainly that information that's required is not being, it's not part of the evaluation process for dam and systems. We'll report back to you on that. If anyone else wants to input on that, that's fine too, of course.
Just clarification, Mr. Reed, are you referring to Executive Order 50?
Yes.
Yeah, so it's Executive Order 50 that was issued some time ago, I believe under a previous administration, and there hasn't been much compliance with Executive Order 50, which talks about employment records and any record of litigation. And so there has been some review by DC 37 of Executive Order 50. I'm not sure whether or not this administration has done so. In addition to that, the Mayor's Council is responsible for WMBE, which includes hiring and includes profile companies that engage in business with the City of New York. And the question is whether or not there has been any oversight with respect to Executive Order 50. And I wonder and question that. And so if you can look into that, that would be helpful.
Okay, absolutely.
Any other questions? Andre?
So once you have all this information, then what are the next steps? I mean, what's the threshold deeming somebody, a firm, not representative enough, or what, like, well, you have this now, then what comes out of it?
Yeah, so these numbers that we're asking for from each of the managers basically gives us a sense of whether they walk the talk when it comes to diversity, pure and simple. And the pieces of information that we would gather, the complexity of the workforce at the board level, complexity of the workforce at the investment decision maker level, and the complexity of the compensation of the investment workforce at the investment decision making level, gives us a sense, cumulatively, about how homogeneous is the decision making group at this firm. We all know homogeneity in decision making groups is associated with groupthink and other weaknesses, and we seek to have decision-making groups that are heterogeneous, that are diverse. And so it is one of the things that we look for in a management team when we look to find suitable vendors for investment management services. We don't look at it exclusively. It's not a 1-0 thing, but we consider it to be a very positive attribute when we find a heterogeneous decision-making group. And we think these numbers will give us that information, which we put into the mosaic when we decide which managers to hire for NYCERS portfolio.
Any other questions? Well, thank you.
Thanks.
Thank you.
Before we get to the next item, just want to reflect the record that the Queensborough President representatives. So our next item is from the public advocate.
So I believe all of you should have an amended resolution. If not, we can distribute it. But on June 30th, I sent a letter to the trustees of all of the 5 pension systems, calling on them to divest from gun retailers because of the risk of owning shares and bonds of firms that are exposing these systems to risk. And I know that as all of us, we sit on this board and we all have a fiduciary responsibility. But I am introducing the following resolution calling upon Bureau of Asset Management and the Callens Associate to ascertain the holdings of NYCERS portfolio and gun retailers, and to provide a transition plan for the board to use for future discussions on how to proceed. And I know within the last few weeks as I've contemplated this resolution, I've spoken to a number of experts who have stated that systems like ours, we can obtain superior performance with less risk by investing in socially responsible alternatives or indexes. And we must explore those alternatives while lowering our risk, or looking into perhaps removing certain holdings in its entirety going forward. I know we take our fiduciary role very seriously, and I do not call upon the board to look at divestment lightly. We must focus not only on returns, but on risk. And gun sellers are in a risky business. And as you all are too aware, gun violence is a plague on our country. In 2015 is projected to be a year when more Americans died by firearms than in car crashes. Lafayette, Charleston, Newtown, Aurora are cities that have been rocked by mass killings. In fact, this past week, 32 people were hit by gunfire in New York City. In fact, not too far from here, I live a few blocks. There was a drive-by shooting less than 10 blocks from where we sit right now. And it rocked my neighborhood this past weekend. These are neighborhoods of our city workers, of our colleagues, and of our families. Since January alone, there have been 16 shootings at NYCHA facilities. These are our members who get hurt and are disabled. 3 NYCHA employees were shot in July 2011, caught in the crossfire at Howard Houses. I remember going to a memorial there. October 2014, the NYCHA worker was shot in the leg at Forest Houses. In 2015, an MTA employee and a new dad, Dustin Jackson, was shot and killed by gunmen in Brooklyn. This past April, shots were hit at an MTA bus near Central Park, and only the heroism of a bus driver who slammed on the accelerator saved the passengers from a barrage of gunfire. In March, a bullet ricocheted off the windshield of an MTA bus in Harlem. A parent coordinator, Judith Daniels, was shot near PS 81, also in Brooklyn. An 8-year sanitation worker was killed by gunfire in 2008. Another sanitation worker was killed in 2006. An on-duty sanitation worker, another one, was shot in 2005. In 2008, a correction officer was shot in the head and killed in East Flatbush. And there are more, and the list goes on and on and on and on. And they're not just limited to Brooklyn, and they represent members from every single union that is a trustee on this board. The cost of gun violence to the United States has been calculated to be around $229 billion. And so I am calling upon NYCERS. NYCERS and the teachers' retirement system prudently divested of gun manufacturers in 2013. That was gun manufacturers, but the job is only half done. Gun retailers are still prevalent in our portfolio, and I believe that we cannot take the risk of investing in any company that profits and promotes gun and ammunition sales. And we are not alone. The mayor of Philadelphia, Mayor Michael Nutter, and the Conference of Mayors looked at all of their exposure, including retailers, and asked them to sign the Sandy Hook Principles. And they recognized the risks associated with both manufacturers and retailers who peddle instruments of death without strict controls and oversight. And by November of 2014, Cabela's and Walmart and others were out of their portfolio. As fiduciaries and trustees, we have a responsibility to decide when a risk is simply not worth it, and when the time has come to say we want out of the gun business for good. And since our 2013 divestment of manufacturers, the gun makers and sellers didn't change their behavior at all, because what we sold off was a pittance compared to their bottom line. And if we really want to get out of the gun business with all of its financial risk and moral hazard, we need to take a look at the risk that put guns into the hands of people who use them. Walmart has a series of headlines of assault rifles and tactical shotguns stolen from their stores. Ammunition has been stolen, sometimes by employees. This is risk to our residents, the company, and to the shareholders. Their sale of weapons, including the AR-15, the Sig Sauer M400, the tactical shotguns, put dangerous weapons into the hands of criminals and potentially terrorists. But they are not alone. Cabela's, Dick's, Big Five are all national sellers of assault rifles, handguns, ammunition, and high-capacity magazines. And the risks include headline and reputation which decrease consumer sales, regulatory risk to stop sales, litigation risk, and business sales. And if you think this is just hyperbole, let me just tell you. The New York Times and the ABC News reported that Chattanooga, Tennessee killer purchased his ammunition at Walmart. In 2011, Jared Lee Loafer shot 19 people, including Gabrielle Giffords, a member of Congress, with ammunition he purchased for his Glock handgun. Where? At Walmart. Guns have been used in hate crimes, such as the April 2014 shootings, where Franzier Glenn Miller, a neo-Nazi killer, killed 2 people outside the Jewish Community Center of Greater Kansas City and Village Shalom, a Jewish retirement community in Overland Park, Kansas. And where did he purchase his Remington Model 870? Walmart. This year, Charles Tan, a promising Cornell student, unable to buy a weapon since he was a Canadian citizen, had a gun, had a friend buy a shotgun where? At Walmart Supercenter. He then used it to kill his father in February. In April of this year, in another Chattanooga, Tennessee incident, domestic violence victim Holly Anderson was shot in both legs by her husband with a gun and ammunition he bought where? Walmart. It's not a convincing argument that firms like Walmart follow the law. So do the manufacturers of which we divested. But as trustees, we look at risk, not only compliance with lax law that varies from state to state. And Walmart has not changed their behavior at all. And unfortunately, federal background checks don't stop people without records from buying, and in many places they don't include known mentally ill people. And these guns and ammo sales still pose significant risk. Shootings on Walmart grounds are so common that there is a blog, and I urge all of you to go see the blog or read the blog. It's dedicated to collecting stories about Walmart and how many people who have been injured or killed as a result of purchasing guns or ammo at Walmart. In fact, there are now 92 such stories on this blog site. Let me also go on to say that Walmart is widely referred to as the most prolific seller of guns and ammunition in the world. And it's something that they have never disputed. However, to understand just how important these retailers are to the gun trade, one need only look at the annual SEC filing of Remington Outdoor Company, which is the #1 manufacturer of high-capacity assault rifles in the world. Remington owns Bushmaster Firearms, makers of the assault rifle that was used to massacre 26 people in Newtown, Connecticut, less than 3 years ago. Remington notes that retailers such as Cabela's and Walmart and Dick's Sporting Goods continue to expand the number of their locations that stock their products. And in fact, 45% of Remington's nearly $1 billion in 2014 sales were directly tied to these major retail and sporting good chains. And the fact is that Remington also lists as its top risk factor unfavorable publicity and negative public opinion as it relates to its gun sales. These are significant business risks, and they are much present for those companies which deal arms directly to consumers. Walmart may not release its gun sale data, but their continuing patronage is so significant to Remington's bottom line that the manufacturer has for years listed its heavy reliance on Walmart as a standalone risk factor to its future financial solvency. And just as the potential loss of Walmart's business poses as an enormous risk to Remington, Walmart's continued sale of guns and ammunition poses a comparable level of risk to this board and to other shareholders. And it's ironic that Walmart refuses to sell CDs with explicit lyrics, yet they don't stop selling the type of gun used in the Newtown massacre and continues to sell hollow bullet point bullets for semi-automatic handguns, which not only puts our residents of New York City at risk, but also our police officers and all of those whose job it is to protect all of us and to keep us all from harm. And so I'm asking that we review our holdings, because right now enough is enough, and I think it's imperative upon us, all of us, to do something. We can no longer hide our head in the sand and say, well, our job is only to look at the bottom line. We need to look at the possibility of divesting from these holdings, and I believe it's consistent with our fiduciary role, but for me it's more important that we do it consistent with our moral responsibility. And I ask my fellow trustees to vote yes on this resolution, and I thank you for allowing me to say a few words.
Thank you. All right, so, okay, we have a resolution on the table. We have a motion.
Motion.
We have a second. Second. All right, the motion has been made and seconded. Is there any discussion on this particular issue? Mr. Rito?
Yes, first I want to applaud the public advocate for taking on an issue for completing the task which was initiated in 2013. I think this is going to be the most fundamental issue for various boards, investment boards throughout the country, but particularly for this board, about how do you balance risk with your investment. I am in full support of this resolution, and I urge my board members to do the same.
Thank you. Any other discussion?
Just one quick comment. I would like to request the law department to do an analysis of the possible impacts of this resolution on any future or current securities litigation.
Certainly.
Absolutely. All right. Any other discussion? All right. All in favor of the resolution, please say aye.
Aye.
Negative vote.
All right. No opposed? All right. Any abstentions?
Okay, resolution number 1.
All right. Thank you. Thank you. So the next item on our agenda is trustee education by Callan. Take it away.
Thank you, Mr. Chairman. So as you all know, that we are about to embark on an asset allocation study for the NYCERS investments. And as was discussed in the past, making a asset allocation decision is probably one of the most important policy decisions that this board can make. It's much more important with regard to future returns as to what that asset allocation will be, much more important than which managers you hire or which stocks you invest in. So today we're going to start with an educational process. We are happy that we were able to bring in Jim Van Hewitt from our home office in San Francisco. Jim was involved and led the effort 5 years ago, the last time we did a study for you all. And Jim's going to walk you through some high-level education on the subject, but we're also going to get in the weeds in a number of areas. So we encourage you to ask questions as you go along, and if we run out of time or you think that we still need more, we can come back and give more. But please ask questions, and this is your meeting.
All right. Thank you.
Thank you. Let me just reiterate what Bud said. I'm happy to have questions throughout at any time. This is really for your education, and I would like to make it as productive as possible. If you look at the first page, you can see an overview of what we're going to talk about. The motivation for looking at asset allocation. We're going to talk about, and here's, I think, where Bud is referring to some capital market theory, but there are some really high-level points that I'd like you to take away from this that I think will help you in evaluating the asset allocations as you review them. In addition, some new theories, some new ways to look at asset allocation that are productive in as much as they give you a different perspective on how to view your asset allocation. Then how we develop the inputs that go into the process, which I think provides some insights, and the pros and cons of various asset classes, some of which you're currently invested in, another of which you're not. And then, as Bill pointed out, we've been doing this for some time with NYCERS, and there are a few pages on how we have conducted these studies in the past to give you a sense investment policies. So while you get updates at all of your meetings as to how the portfolio is performing, we don't propose that you review your asset allocation that frequently. As Bud pointed out, the last major asset allocation that we did for you, the last major work that we did for you was several years ago, and we feel that that's appropriate. And that's what we do with all of our clients unless there's some substantial change in the liabilities that they're funding. So this is a periodic 3 to 5 to 10-year process that's done. And the overall approach to the process is to evaluate the return potential from different asset allocations in the context of the risk that these asset allocations introduce. So over the long run, you can earn higher rates of return if you have a riskier portfolio, but in the short run, you're going to have greater volatility in your asset values in the pursuit of that higher long-run return. And the way that you come to a conclusion as to your appropriate asset allocation is to compare those trade-offs. And let me say that while we'll go through a lot of quantitative data in the course of this presentation and the asset allocation, in the end, the selection of the asset allocation involves a lot of subjective judgment. We can have two different pension funds that have the same underlying circumstances and yet come to different conclusions as to the appropriate asset allocation for their individual fund. And that's totally appropriate. However, the context, if you turn to slide 4, is the same for all. And it's an interaction between 3 different policies which drive the function of any pension fund. At the bottom, if you look at the blue bubble there, you'll see a benefits policy. That's how much you're going to pay to the members of the fund. On the right, you have a funding policy, and that's how you're going to pay in assets, how you're going to make contributions to the fund to support those benefits. And the third bubble on the left, the green bubble, is how you invest those assets. So in summary, you have benefit policies, what you owe, the funding policy, what you're going to save, and the investment policy, what you're going to earn. And the combination of those 2 policies on the top, the investment policy and the funding policy, have to add up to what you pay. So the more you earn in investments, the less you have to fund. Conversely, the more you fund, the less you have to earn in investments. But in the end, the combination of those 2 have to add up to what you owe for benefits. Any questions on that? That's why we're here. If not, I'll move on to slide 6. And we conduct our asset allocation studies on the basis of capital market theory. So we wanted to give you some background in this area. And capital market theory is, just in general, how you compare the returns and risks of different portfolios and how you construct those portfolios. So capital market theory applies to both individual investments and to investments in portfolios of investments. And so the construction part is, what should the return target be? And how should that return target be traded off with your risk tolerance? You can earn more in the portfolio, as I said before, by taking additional risk, but you can only reduce risk by taking less return. So since it's an important concept, I'm going to take some time to discuss risk and how risk is measured on slide 7. And there are really 2 ways to look at risk. One is a historical perspective, and the other is a prospective perspective. And the historical perspective is volatility. It's standard deviation. It's probably something you've heard about before. How much volatility have we had in the past? Versus what we use to come back to you to make suggestions with regard to your asset allocation. And that's uncertainty. We don't know the path of different asset classes going forward. We have to make estimates as to how much volatility there's going to be in portfolios going forward, what the potential return path should be for individual asset classes, and what they should be for portfolios as a whole. And the risk is, in the 4th bullet point, as I pointed out, is important because that is intimately connected to the return that you're expected to earn. It's important to recognize the last bullet point that whereas you can measure returns over a given month or quarter, it takes time to measure volatility. Volatility measurements develop. So for example, after the financial crisis, even though we knew that markets were volatile, it took months and even years to determine how volatile they were in retrospect. So risk is not a point-in-time measure. On slide 8, we talk about standard deviation, which is the common measure of risk. Standard deviation is an absolute measure of risk in as much as it's not a measure relative to an index. So it's not like tracking error where you see how much your manager deviates from the underlying index against which they are measured. It's defined in historical terms as an average deviation from the average rate of return. In prospective terms, it's defined as the expected deviation from the expected return. And it's I think, useful as we look forward in determining the asset allocation to think of volatility in terms of uncertainty. We don't know what's going to happen. We're going to make our best estimate to determine what's going to happen, and we're going to use that as our measure of risk. The last bullet point is one that's important, and that's that when we measure risk, we measure volatility both above and below the average. So we think of risk as being a loss of assets, but there's information in returns that are above the expected rate of return in terms of volatility. And I think the best way that I can describe that is that, prior to the bursting of the tech bubble, so in the late 90s, we used to interview a lot of managers, and managers came in and said, yes, we have a lot of volatility in the portfolio, but it's all good volatility. We're always above the average rate of return. We have volatility of positive assets. But in retrospect, that amount of volatility that they have in terms of positive returns was, after 2000, reflected in negative returns. Those managers that had large positive volatilities also subsequently have large negative volatilities. So while people will argue that really you only need to look at the downside, I would argue that you need to look at both sides because that can be informative as to the downside.
Excuse me.
Yes?
How do you measure regulation in the context of this risk? How regulated a particular asset allocation is?
The measure of volatility is, in terms of standard deviation, is an all-inclusive measure of volatility. And so it includes regulatory risk, it includes illiquidity, it includes all the contributions, political risks to the overall volatility. And that's an excellent question because it really speaks to why I wanted to define volatility going forward as uncertainty. Because regulatory risk is an uncertainty that we try to incorporate as we have a forward-looking measure of volatility. So it is included to the extent that we can evaluate it in our prospective measure of risk.
Henry, are you thinking of regulations like the basket clause? Is that?
I'm also thinking about SEC regulations, particular investment allocations, what they're required to provide, level of disclosure and whatnot.
Yes, and that's, as Bud pointed out, we're looking at broad asset classes at this level. So things that impact specific managers are addressed at a subsequent evaluation.
Relative to the basket clause, which does constrain portfolios in New York State, we would do a constrained optimization. So you look at, if you didn't have that constraint, what would your choices be? And then, given the constraint, so it's that you constrain the optimization.
Yeah. So
Sorry to interrupt.
No. That's an excellent answer. So we do explicitly take the basket clause into account.
And when we think about asset allocation, manager risk is going to be more pronounced in certain asset classes than others in terms of implementation.
With that, I want to give you some intuition in terms of how risk is measured and evaluated. And this is a area that Bud referred to a little bit down in the weeds, but I think it's helpful in thinking about risk. And on slide 9, I'm looking at historical standard deviations, and clearly this is a fictitious asset class, which we're just calling investment A for the purposes of this presentation and to define risk. And notice as we look historically, in this case, we're theoretically looking at the last 15 years of returns. What we do is at the end of that 15 years, we calculate an average return. And that's reflected in the yellow line. And even though the yellow line goes across all of those years, in fact, it's only calculated after the 15th year. And once we've calculated that average return, what we do is we measure the deviation around that average return. And that's our historical measure of volatility. So more volatile managers would have greater deviations around that average return. Less volatile managers, obviously that deviation would be less. That deviation is independent of the absolute value of the average return. So a manager who, in this case, the manager has an 8%, or excuse me, the asset class has an 8% average return. If these same deviations were witnessed around an asset class that had a 3% return, it would still have the same volatility. Around a 12% return, these deviations would have the same volatility. But again, we only know this at the end of the period and after we've had the opportunity to measure the average and then measure the deviations from the averages. Historical standard deviation is different from the uncertainty of measuring future standard deviation. And that's discussed on slide 10, where we look at the opportunity for different returns going forward. So we'll say, for example, we're looking at the equity market. We'll say that economic growth could be high or low. Profitability could be high or low. Productivity could be high or low. And the lower values lead us to subsequent values that are on the bottom of this sort of sideways pyramid here. Whereas conversely, if economic growth is high, profitability is high, productivity is high, then we get the upper values here. And it's the combination of looking at these different scenarios that lead us to conclusions about how much risk might be in a given asset class going forward. Now, I've talked in these two slides about the theory of standard deviation. In practice, on slide 11, I summarized by the subtitle here, volatility is volatile. So it's very, very difficult to forecast volatility going forward because it has historically varied very substantially. So what we're trying to do in our prospective measures of volatility is to encompass what the average value of this volatility may be, but also look at the ranges of potential outcomes that are reflected in this variation of volatility. That's absolute volatility in a nutshell. Are there any questions about how we measure risk of individual assets?
I have a couple of questions. First, with regard to kind of, we have the kind of measurement of risk, and then kind of, does Talon do any type of exercise with the board when it comes to things like risk tolerance and thinking about the kind of what our risk tolerance is? You talked earlier about you can have a spread of options depending on, basically your risk tolerance, whether or not you want to, there's going to be a number of options that could kind of get you to a certain place, whether you want a lot of volatility or a little bit. Do you do exercises with the board during your asset allocation on risk tolerance?
Yes, we can. We can do those on a number of levels. I think primarily what we've done historically is to look at, given our prospective view of risk, we talk about a standard deviation number, and let's throw out a number. We have 7% expected rate of return. Let's say that the standard deviation on the portfolio is maybe 11. Well, it's difficult intuitively to say, is that the right standard deviation, or do we want 10, or do we want 12? How do we make that risk-return trade-off? What we've done historically is to essentially replicate what's on slide 8, but do that thousands of times. And you get a range of returns. So if we had an expected rate of return of 7%, what we'd show you is that over 1 year, maybe that there's a 5% probability of having a return of, let's say, 22%, but also 5% probability of having a return of minus 12%. and we'll do that for 1 year and 5 years and 10 years, since this is a strategic exercise, to give you a more intuitive sense of what that 10 or 11% volatility looks like. And so that you can say, well, gee, if we had, turned to the actuary and said, if we had a loss of 12%, what would the implications be for the plan as a whole?
Mostly at kind of the more at the plan level, and then I guess I was getting at is that kind of the discovery of our own risk tolerance. I guess it's kind of my thinking about it, is that thinking about ways that we can discover our risk tolerance.
So, Antonio, I completely agree with you, and this is one of the things we're just about to sit down, not only with Callan, but with the consultants, all 5 of our consultants who are simultaneously doing asset allocation reviews across the 5 systems. And being able to serve up to you the implications of various choices on risk tolerance is one of the most important jobs that we have in serving up asset allocation options. So we're going to talk a lot about that, and hopefully come up with something so that you can translate a lot of these academic notions into real life to be able to make choices, because we are making big choices here. As Bud said at the outset, these are some of, in fact, these are the most important choices that you make as a board.
And thank you for raising that. Particularly if you go guidance on the discussion of risk tolerance and risk aversion, particularly for defined benefit plans. While we speak about probabilities and uncertainties, one thing that I think we're all particularly clear is that we have 100% certainty that we have to pay off our beneficiaries and pensioners, right? That's ironclad, many ways legally protected, constitutionally. So I think what does that certainty that we have, right, 10 years out, 20 years out, 30 years out, 40 years out, do to our decision making in terms of making sure that we make decisions consistent with that, and I think that would be very helpful for me, and I imagine others, to make sure that we meet those goals that are defined.
Absolutely, and I'll tie 2 points together, building off of your point, and that's that we said that this is a strategic asset allocation, and we intend for it to last for 5 to 10 years. If we don't properly assess your risk tolerance, and we test the bottoms of some markets, and you decide that that's more risk than you had, that you feel that you could tolerate, and you change your asset allocation when the market is down, that's probably one of the worst things that could happen. So we want to be very careful that we gauge your risk tolerance as closely and appropriately as we can. So we agree that's a key variable.
And one of the difficulties is that each individual may have their own different risk tolerance, but as a board, you need to come to a consensus on what you can live with, what you can tolerate on the downside in order to achieve the return.
Now, I'll go from the risk of individual asset classes and total portfolios into diversification, which is another key concept. But it's easily summarized in don't put all your eggs in one basket. And the object of diversification is risk control. And by that we mean that if one asset class is down substantially, we hope that other asset classes are up. And they balance that downward movement of the original asset class. Interestingly, and I think something that people don't always recognize, is that diversification works both ways. In as much as you can have a perfectly outperforming asset class, U.S. equity over the last several years, and the diversification of the portfolio in terms of other classes has actually restrained that return. So it's something that cuts both ways, but something that's absolutely fundamental. What we want to do, and I'll make this point several times, is we want to maximize the diversification of the portfolio consistent with the return objectives of the fund. And we're back down in the weeds. Diversification is measured by correlation, And I think it was important to bring this up because correlation numbers are often discussed, and I want to give you some context for those numbers. Correlations range from -1 to 1. And there's some, I think, some misunderstanding with what those numbers potentially mean. I'm actually going to start with the bottom bullet point. The correlation of 1 at the bottom of slide 13 means that there's no diversification. That asset classes move exactly in lockstep with one another. And so having two asset classes that have a correlation of 1 introduces no diversification. Conversely, correlations of -1 means that they move exactly asynchronously. So they perfectly diversify one another. Unfortunately, there really are no asset classes that perfectly diversify one another. We would love to have them, but the only possible combinations of investments that would have that characteristics essentially earn cash rates of return. Where the confusion usually arises is in a zero correlation. And what that means is that the relationship between the returns of two asset classes that have a zero correlation is random in nature. Sometimes they move up and together, sometimes they move down together, sometimes they move exactly opposite one another. In advance, you're saying that the return of one asset class has no implications for the return of the other asset class. So people often think that zero means that asynchronous level of diversification. In fact, it's a random level of diversification. With that, I'll turn to slide 14. And again, this is a theoretical measure of correlation. But I would actually argue that this is probably one of the most important slides that we'll talk about today because it gives you probably the best intuitive feel for the importance of diversification. Now let me take a minute to set up what's being shown in this slide. We have two asset classes as opposed to the standard deviation slide where we had one, although essentially the setup is the same. We see volatility for investment A, which is in blue, and we see the volatility of investment B, which is in yellow there. And the whole point of this is that both investments have the same expected rate of return. And both investments have the same volatility, have the same standard deviation. As you can see, they have the same peaks and troughs. So the same amount of risk in both asset classes, the same expected rate of return. But there's only a small amount of asynchronous behavior between these asset classes. They certainly aren't zero correlated. They certainly aren't correlated to -1. It's a correlation of about 0.5. But if you look at the green box and the green arrow next to that, you can see that the volatility of a portfolio of 50-50, 50% in each of these asset classes, is measurably less than the volatility of each of those individual asset classes. So even though they have the same expected rate of return, the same volatility, these individual asset classes have the same volatility, combining them just by virtue of the asynchronous nature of the return reduces the risk of the entire portfolio. And by the way, since they have the same expected rate of return, this reduction in risk comes at no cost to the return of the portfolio. The portfolio earns the same return as the combination, or as the individual asset classes. So diversification is a very powerful risk reducer. You want to pursue it wherever you can find it.
Another important reason why you want to reduce risk that is not typically visible to when you look at this page is every month you're paying out benefit payments. And if you are paying out benefit payments in a down month, you don't have the ability to recoup the gain on those assets in an up month. So having a reduced amount of volatility is beneficial when you're paying out benefits.
Questions on that? If not, we have the same issue with correlations as we have with standard deviations. That in practice is that correlations can change significantly over time. And so they are very difficult to forecast. And so consequently, when we look at correlations in the simulation analysis that we discussed before in terms of looking at ranges of return over different time periods, we vary the correlations in those so you can get a sense of the impact of different levels of correlations on the total portfolio risk. that as background, these concepts of risk, return, and correlation were first introduced by Harry Markowitz when he developed modern portfolio theory. And the insight of modern portfolio theory is that it quantifies this notion of diversification in terms of correlations. It's not that people didn't understand that some investments diversified each other previously. It's just that there was no quantitative measure of that before. And that is really an important step, because now it allows us to measure the relative diversification available from different asset classes. And all else being equal, we would choose the one that offers more diversification. It also allows us to actually calculate a portfolio risk, calculate a portfolio standard deviation. That was not possible before the introduction of modern portfolio theory. And that ability to calculate a portfolio standard deviation is important because it allows us to determine probabilities of different levels of losses. I talked about before, again, with that example to help determine risk tolerance, I talked about a 5% probability of a given level of loss. In the absence of modern portfolio theory, we would not have had that ability. Modern portfolio theory on slide 17 also gives us the ability to construct alternative portfolios. And we begin that process by defining any limitations that we have on the different asset classes that we're going to review. And we leave them out by a priori, saying that we have a zero allocation to that asset class, and we leave them unconstrained by allowing them to have a 100% allocation to that asset class, although we never achieve that. And the investment allocations, the allocations to these different asset classes are, given the expectations, given the expected returns, risks, and correlations for the individual asset classes, are what determine the portfolio return and risk. So if we want to have a discussion about whether a given portfolio has an intuitive level of return or risk, we don't look at that portfolio itself. We look at the underlying expectations for the asset classes and determine why it is that a portfolio has the return and risk that it does, and determine if we have any objections or questions about the returns and risks of the underlying asset classes. We use those underlying returns and risks to construct these portfolios in a certain way. We can have a targeted level of return, say 7% your actuarial discount rate, and what modern portfolio theory does is it allows us to combine the asset classes in such a way that we achieve that expected rate of return at the minimum amount of risk. We can construct other portfolios that also have a 7% expected rate of return, but all of those other portfolios, given our inputs, would have higher levels of risk. And as I said before, once you achieve that optimal level of risk for a given rate of return, the only way to alter the return is to alter the risk. If you want to earn more, you have to take on more risk. If you want to reduce risk, you have to take on less return. And as I said before, and it's worth repeating, the bottom bullet point here, what modern portfolio theory really does is it maximizes the diversification of the portfolio. You can't introduce additional diversification by altering any of the allocations to the different asset classes. On slide 18, we get to the concept of the efficient frontier. As I've noted, there are, for different target rates of return, different portfolios that minimize risk. Actually, there's an infinite number of these, and that's what constitutes the efficient frontier. We'll only talk about portfolios that earn different return increments, usually 25 basis points in return increments, but recognize that there are compromised portfolios in between any of these that we'll specifically evaluate that also have these characteristics, and that's what constitutes the efficient frontier. And it begins at the portfolio that has the minimum level of risk and goes on out to a portfolio that has 100% in the asset class that has the highest rate of return. It's worth noting that the minimum risk portfolio is not necessarily and often isn't a portfolio that just has bonds in it, just has low volatility bonds in it. Because of the level of diversification that equity introduces, the minimum volatility portfolio often has 15 or 20% equity in it because of diversification characteristics between stocks and bonds. On slide 19, we have a graphical representation of the efficient frontier and some of the concepts that I've talked about so far. If you have a suboptimal portfolio, in other words, you're not maximizing the return for a given level of risk, notice that you can move from this red triangle up to the efficient frontier and earn more return for the same level of risk. Conversely, if you're comfortable with the rate of return that you're earning with your suboptimal portfolio, you can reduce risk by moving horizontally to the left and still maintain the same level of return, but have less volatility associated with that by altering the construction of the portfolio. And you can choose something in between. You can choose a portfolio that has modestly more return than your suboptimal portfolio and less risk. So to the extent that you have a suboptimal portfolio, you can move up to the efficient frontier in a variety of ways that match your risk tolerance. Now this is, yes.
Just kind of going back to the idea of diversification. Does Alan, when they kind of do the final presentation, y'all do a principal and components analysis along with this for each of the asset classes? Or like an analysis of like the underlying kind of factors?
Yeah, I think Jim's going to talk about that when we look at new
so
theories.
Say that one for when you're going to talk about it.
No, I mean, that's actually a terrific segue, because while modern portfolio theory is very useful, it's not the only way to measure risk. There's value at risk. There are factor risks, like if you use a Barra type model that looks at the underlying equity or fixed income model and decomposes, this gets back to your original question, decomposes this standard deviation into a variety of components that we can look at individually. That's certainly something that we can look into as what the contributions to risk are. As a matter of fact, several years ago, the last time we did the asset allocation study, what we did was we literally decomposed the standard deviation of the total portfolio and looked at the contributions of the different asset classes to the overall risk of the portfolio. And what we found with your portfolio, as we found with your peer portfolios, the portfolios of your peers, is that equity is the prime contributor to risk. Actually, fixed income contributes only a very small amount of risk to the overall portfolio. And at that time, the decision was made to diversify the portfolio into other asset classes, such as hedge funds, to reduce the amount of risk exposure that the portfolio had to equity. So we did that risk decomposition. Other things that have been developed since the last time that we did this are shown beginning on slide 21. There are two other ways that are popular for looking at the risks of the portfolio. One is grouping asset classes by the roles that they play in the portfolio, by how they respond to different environments. And what you see on slide 21 is we have two axes here. We have inflation, which goes horizontally, so low inflation to the left, high inflation to the right. We have economic growth, which moves vertically, with low growth at the bottom and high growth at the top. And we see that different asset classes tend to perform well in these different environments. So in a low growth, high inflation environment, inflation-linked bonds, not surprisingly, would be expected to perform well. In another instance, high growth, high inflation environment, real assets tend to perform well. This is generally used as an overlay to the modern portfolio theory approach for a variety of reasons. First of all, these 4 quadrants that we show here, and you can do this in a variety of different ways. You don't have to do it just in terms of growth and inflation. But in this case, the probabilities of any of these quadrants are not equal. We're more likely to be in higher growth environments than we are to be in lower growth environments. We're more likely to be in moderate inflation environments than we are to be in a deflationary environment or a hyperinflationary environment. So consequently, you have to figure out how you weight each of these economic scenarios. Secondly, while we say that these asset classes tend to do well in these environments, they don't always do well in these environments. So you have to account for the risk that they may underperform in an environment in which we expect them to outperform. And thirdly, and this is another important point, and that's that we talk about inflation on the horizontal axis. Well, asset classes will behave differently depending on whether that inflation is expected or unexpected. So, for example, in the 1970s when we had the oil price shock, asset classes that should have done well in an inflationary environment didn't necessarily do well because that was a surprise, a surprising increase in inflation. Whereas if we have inflation moderately picking up, then we expect the behavior of these asset classes to be more consistent with our expectations in an inflation. The second, or I guess I should say the third way of looking at asset allocation is shown on slide 22, and that's goal-based investing. So we set different goals for different portions of the portfolio. We have a growth portion of the portfolio. We know that there's a lot of risk involved in these growth types of asset classes. So we have a risk mitigation portion of the portfolio, asset classes that are meant to reduce the volatility of the growth portion of the portfolio. And then we have often real asset classes and diversifying asset classes, both of which are intended to diversify both the growth and the risk mitigation portions of the portfolio. This is useful to get a sense of, are we covering all the bases in the asset allocation that we have? Do we have things like real estate and infrastructure and those types of investments that will do well in these inflationary environments and yet also diversify the growth and the risk mitigating asset classes? The diversifying asset classes that we list here are reasonably new in nature. Multi-asset class portfolios are just starting to be studied for the most part, and these differ from the historical tactical asset allocation managers that we've looked at before, global tactical asset allocation managers, in as much as they tend to have more freedom to move among more asset classes. They have more freedom in terms of the way that they make their investments. In some instances, they can bet against an asset class if they feel it's going to underperform. But in the end, again, this is kind of an overlay. This is once we establish our risk tolerance and we have narrowed in on a range of portfolios that we want to look at, we are looking at just, are we filling all of these buckets here to make sure we're properly diversified. So any questions on those other ways of looking at the risk mitigation?
One, these are relatively newer, or different kind of ways to look at the traditional asset allocation. And seeing as, certainly for this round, is going to be primarily the way we're going to do it that traditional way. How would you recommend integrating these thoughts into, as we're thinking about doing our overall asset allocation, how to integrate these sort of concepts into, as we start to look at when you guys look back at the analysis?
Yeah, that's terrific. And I think the way that shows up is we come up with similar exhibits, and now we apply numbers to these to say, all right, well, in the low growth, high inflation, we have tips in the portfolio, and we have them at 5%, and we look at how that allocation compares to what we think the probability of that scenario is. So we actually have physical numbers that we can put to the quadrants here and to the silos that are on slide 22. And we'll say, okay, does that, and as I said, a significant portion of this process is subjective in nature, and we can get a gut feel for, do we have enough diversifying assets? Is the allocation to the risk mitigating asset classes, is that substantial enough that we feel that we're covered if we have another type of financial crisis? So really what it engenders is more discussion of the asset allocation with the intent that people become more comfortable with the decision than they would be if it were quantitatively done. I think that's the real value of these two types of two ways of looking at it. With that, as I mentioned before, we have to have inputs. If we're going to use modern portfolio theory as the primary way to construct the alternative portfolio, we have to generate those inputs in terms of returns, risks, and correlations. And that's essentially what we do at the beginning of every year. And while we revisit every year, I want to remind you that the expectations that we generate are 5 to 10 years in nature. So when we revisit this on an annual basis, we're only tweaking around the edges. We're only looking at what happened in the prior year and what might happen in the out year of this time horizon, and then altering slightly the expectations that we've generated for each of these asset classes. And we begin the process by looking at the underlying economic environment. And when we looked at this for 2013 or 2015, we focused on 6 primary questions. And that was the outlook for growth, economic growth, both in the U.S. And especially in the developed markets in Europe and Japan, but also in the emerging markets. We discussed a little bit earlier, Scott mentioned that growth in China is slowing. What impact will that have on our equity expectations? Where is inflation likely to head? If you remember at the beginning of the year, deflation was a concern in Europe and in Japan, as it had been in Japan for some time. So we wanted to evaluate that question specifically. The perennial question of when interest rates are finally going to bottom out and start to rise. On slide 25, if and when rates do rise, what's going to be the impact on the U.S. fixed income market? I think you're all familiar with the inverse relationship between interest rates and bonds, that when interest rates go up, the value of bonds go down. We wanted to look at that in more depth in terms of the absolute amount that interest rates might go up and the rate at which they could go up, because the speed and size of interest rate increases has an impact on what fixed income returns, what bond returns are going to be. There was a concern at the beginning of the year about the valuation, and continues to be concerned about the valuation of equity markets, given that over the prior 6 years going into 2015, we had an S&P return of cumulative return of 160%, and the Russell 2500, a measure of small and mid-cap stocks, was almost 190%. Did that mean that stocks had their run and were likely to retrench? We wanted to evaluate that. And then offshore.
Yeah, I am still on page 24 because of government debt. United States government debt. How much of an impact will that have on our ability to grow?
Well, U.S. government debt is a topic that we could spend a long time on. Let me try it and summarize that. There are several concerns with regard to the size of any government's debt. And I'll start by saying that we don't have an issue on the order of the issue that Greece has. We don't have a problem on the order of the problem that Japan has. Japanese government debt is currently on the order of 200% of GDP. The U.S. government debt is a little bit south of 100%.
A little bit south of what?
100% of GDP. So our problem is more manageable than other countries.
Why I ask you, if I read Paul Krugman, he seems to think at this point it's really not an issue, it's a temporary situation, we shouldn't panic over it. And then I read somebody else says, yes, we should panic over it. So that's why I asked you.
Yeah, and that Professor Krugman makes an excellent point that the level of debt is consistent with the level of debt we had, for example, at the end of World War II. And what happens is that in his school of thought, and there are, as you point out, two schools of thought, is that we will outgrow our government debt. That in fact, we never ultimately repay it, we refinance it, but it becomes a diminishing portion of the overall economy. Others say that there are a couple of issues, and that's that U.S. government debt could crowd out private debt. And what that means is that if there's a lot of U.S. government debt, then corporate issuers have to pay a higher interest rate in order to attract lenders to their debt, and that has a negative impact on corporate profits. The other potential issue is that while we have a large amount of government debt now, low interest rates mean that our debt servicing is a relatively small portion of the U.S. government budget as a whole. If interest rates rise, and we anticipate that they will, that becomes a larger portion of the federal deficit, which could restrict spending in other areas, which could have a negative impact on economic growth. So it is an issue that when we come up with our expectations for fixed income going forward, we actually forecast the portion of U.S. debt that's going to be in government debt. We forecast the impact of rising interest rates on potential government expenditures, and we forecast the impact on corporate bonds so that the legitimate concerns about corporate debt are integrated into our expectations for bonds, our expected returns and risks for bonds over the next 5 to 10 years. So there is no, I'm afraid in some ways I haven't answered your question because I think there's a great deal of uncertainty as to the exact amount of impact on that U.S. government debt will have on investment markets, but we've tried to look at a range of outcomes and incorporate that in our expectations.
And there are also separate potential impacts to the economy, not just markets. So to your original question about there's opportunity cost to debt servicing. The government's spending a lot on debt servicing versus what it could expend in capital elsewhere.
Yeah, so it's non-discretionary spending, and non-discretionary spending crowds out discretionary spending.
Well, thank you.
And then I mentioned that there was concern about U.S. equity market valuation, but also non-U.S. equity market valuation, and whether non-U.S. equities could overcome the headwinds that they were facing. There was slow growth in Europe. There was a potential for deflation in Europe. Greece was still on the horizon as it is today. What impact would that have on developed markets? And as I mentioned before, emerging markets still have high levels of growth, much higher levels of growth than developed markets, but that's slowing to the point where emerging markets have yet to fully recover from the financial crisis. So what impact would that have going forward? And while we like to talk about, and we certainly believe that this should be strategic in nature, these projections should be strategic in nature, we can't do that without recognizing that there are really going to be two different time periods over this investment horizon. One in which there are rising interest rates and potential volatility in equity, and in the first, let's say, 3 to 4 years of the projection, and then the subsequent term where interest rates will probably have risen to levels that are more consistent with their long-term averages, and the equity market is probably more likely to be valued more consistent with its long-term average, and that will have a different set of returns associated with it.
Jim, in the interest of time, it may just be worth noting that we're taking taken into account a lot of these different themes that are playing out in the markets that all go into our expectations. And one of the difficulties that BAM might have is that the other consultants have their own opinion on where the expectations are. So our expectations is what's going to flow through in our asset allocation study, and it might be a little bit different than what another consultant might say. But suffice it to say that we are considering all these different things that are going on in the market, where interest rates are, where we expect them to go, things like government debt, and it may be a good idea just to cut to our expectations.
Sure, I'd be happy to do it. I would just summarize the prior pages by saying that we are cautiously optimistic about both economies and markets. And I think at least throughout the initial part of 2015, I think that cautious optimism has been supported. Growth started out slowly in 2015 in the U.S., but has since picked up. It's actually negative in the first quarter. Growth has picked up in developed Europe. It's picked up substantially in Japan. Deflation seems to be receding into the background. There appears to be opportunities for more inflation. And it looks like interest rates, when they rise, are going to rise at a moderate level. And they're not going to increase dramatically. They're not going to have a long-term, hugely negative impact on fixed income. And with that as background, I'll go to slide 31, where we have our expectations for a broad array of asset classes that we look at. But really, I want to focus on 4 items. If you look at the very top, you can see we have these divided into equities, fixed income, and others. At the top of the equity box, you see we have U.S. broad equities. So Russell 3000, a very broad representation of the U.S. equity market. If you look at the first highlighted column, the 10-year geometric, this is the 10-year compounded return. So this is a return that takes into account volatility. You can see we have an expected rate of return of 7.6%. What I'd like to say about that is that that's lower than historical averages by a significant amount. It is something that is relatively close to your actuarial discount rate. So if you want to have a portfolio with a 7% rate of return, chances are you're going to have a significant amount of risky assets like stocks in that portfolio. If you look down under fixed income, the second line down, domestic fixed income is measured by the Barclays aggregate. That's a 3% expected rate of return, substantially lower than the equity rate of return. So how much can we afford to have in the portfolio of an asset class that has a 3% rate of return? I would argue a significant amount, because now I want to move over to the other highlighted column, and that's the projected standard deviation. And you can see for the Russell 3000, that's 19%. So what that's saying is that with a 1 standard deviation event, which has about give or take a 15% probability of occurring, the equity markets in any given year could be down 7.6% minus 19, so down at a double-digit level, versus fixed income, which has a 3% expected rate of return, but only a 3.75% standard deviation. So it could be down, but it could be down a fraction of a percentage point, 1 standard deviation down. So this fixed income, that's the risk mitigating asset class that we talked about before, is still important, even with a low expected rate of return.
Quick question. The asset class you have listed as listed infrastructure, is that an infrastructure substitute, or is non-listed securities, would that be considered in the private equity class or other?
Yeah, we sort of threw in the whole gamut of returns and risks here. That would be a publicly traded exposure to infrastructure, and we can address infrastructure that's not publicly traded.
Thank you.
And I think I'll
Given the 10-year geometric and the standard deviations, the weights that we may have on each of them in terms of the new asset allocation, were you kind of intimating that the actuarial discount rate of 7% is probably too ambitious in the 10-year, in the next 10 years?
No, I don't want to say explicitly that I'm not trying to suggest that. You can create reasonable portfolios with these expectations that achieve a 7% rate of return with what has generally been considered a reasonable rate of risk. You may choose to have a portfolio that has less risk and for some period of time choose to underperform the actuarial discount rate in anticipation of when returns are higher, taking the same amount of risk and outperforming the actuarial discount rate. But I'm not saying that it would be difficult to construct a portfolio that achieves the actuarial discount rate over the investment time.
But since the actuarial rate is a given for us, it gets back to the question Antonio was asking earlier. So what are the risk implementations of the portfolio that we need to have to meet the assumed rate of return? So this whole exercise will tell us a great deal about that. And the more we can make those risks understandable and tangible and put them in the context of things that the board can weigh, the more we'll understand the dilemma. But it's theoretically possible to get there. It's not theoretically possible to get there with a low-risk portfolio.
Right. It's not theoretically possible to get there with portfolios of volatility of 6 or 7%. But a volatility, like I said, of 11 or 12%, which would be consistent with a 7% return, would not be unusual for public pension plans of your size. So you would not be an outlier in pursuing a 7% rate of return. As a matter of fact, many public pension plans pursue higher rates of return by force of the fact that they have higher discounts. Did I answer your question? I want to make sure. Okay. I'm going to skip over the correlations because that's really deep in the weeds in the interest of time. We did have, beginning on slide 34, a brief discussion about additional investment strategies, some of which you have, one of which you haven't introduced too significantly into the portfolio yet. So we talked about private equity. I'll just summarize by saying that the private equity is basically a return-focused play. It is like public equity in as much as it generally involves ownership positions, but it's illiquid in nature, and you're expected to be compensated for that illiquidity. And to the extent that you want to invest, to the extent that you are invested in private equity, that is going to be a long-term investment. It's on the order of more than 10 years in the portfolio before those liquidated. Real estate is something that you also have in the portfolio. That is a diversification play. It has returns between those of stocks and bonds. It tends to have a lower correlation with stocks and bonds than other asset classes. Because it is a privately traded asset, it tends to have low experienced volatility, but it is also illiquid, not to the extent that private equity is, but it's illiquid. And both of these asset classes, private equity and real estate, have higher fees than you have in stocks and bonds. I have to apologize for a formatting error here as we get down to hedge funds. The last two bullet points in real estate are actually, well, both the advantages and disadvantages are actually the first two bullet points for hedge funds. So hedge funds have potentially higher risk-adjusted returns. That's the first advantage. The returns are generally between stocks and bonds. The objectives of hedge funds are capital preservation and reduced volatility, and they tend to diversify other asset classes pretty well. On the disadvantages, the first disadvantage is illiquidity. So that bullet point says illiquid, often significant exposure to poorly traded investments. That applies to hedge funds. Some key risks can't be quantified. They have high fees, but also there's an absence of transparency, and you don't control the assets in the same way that you would control your publicly traded stocks and bonds. And an implementation is critically important. Since hedge funds are essentially manager strategies, you gotta hire good managers. You're not gonna get an index rate of return or something slightly less if you hire them.
In terms of that, I know we're in public session, we're doing this as an education session, but unlike a lot of the other classes, hedge funds have, issues of access. And when you calculate the overall data, you're including this as an overall class, not necessarily those in which we would have access to, or those that we would select. So for our purposes, I think it would be important to kind of see where our selected managers would be overlaid on this relative over a period of time that they've been in existence. And whether or not that increases the risk of looking at this as an asset class. We may not be able to get certain access.
I think that's a terrific point. And there are two levels of access that need to be addressed. Number one, and many of these funds, as you point out, are closed. I think that you are in a better position than many entities to get access to top-tier funds, first of all. Secondly, the question that's often raised in the context of a fund of your size is, can you get enough access to enough of these superior managers to make it worth your while? And those are both questions that should be addressed in the evaluation of the hedge fund allocation.
From the time I joined this board, I've had issues with the fact that we're investing in hedge funds for many of the reasons you outlined. Transparency, obviously, the potential for fraud, and certainly the lack of protections on the federal law. When you started your presentation, I asked about the issue of regulatory compliance, because I do know that, for the little that I know, that hedge funds are not required to have the same level of compliance on the SEC rules, and are not required or are not protected in the same type of state law when it comes to disclosure and transparency, which I think is critical to our risk application. But I want to understand how do you value fees in the disadvantages? We've had a lot of discussions about the high level fees, and certainly the Comptroller's Office has done a great job exposing this issue. Are the fees consideration within that asset class considered on the basis of what the industry standard is, or on the basis of what our portfolios perform?
Our expectations for hedge funds are net of industry standard fees. So to the extent that you pay fees that are lower than the industry standard, that's a plus for your hedge fund application.
So in the bullet that says high fees relative to public markets, you are referring to net of fees, right, net of investments?
The reason that bullet point is in there, I want to say this in a politically correct way. Some people just have fundamental problems paying high fees. They understand that the returns that they earn net of fees are valuable to them, but they take a principled stand that they won't pay high fees, and that's what we're acknowledging in this bullet point. It's not saying that when we look at how hedge funds fit into your portfolio, we ignore fees, or fees are an add-on afterwards. It is integrated into the analysis. We just point this out for people who principally object to paying managers like this.
I'm sorry, just one. In the bullet before that, and I assume this is what you meant, but it belongs to the bullet before, there's a language that says lack of transparency, potential for fraud behavior. Is that referring to hedge funds?
Yeah, it is specifically referring to hedge funds because of the absence of transparency.
And how do you balance what you say initially? You said you wanted to have a 3 to 5 year outlook on a particular asset with the kind of lack of transparency that can lead to potential fraud?
We are looking at the hedge fund asset class as a whole. And fraud applies to individual hedge funds. You would have, and you do have, a diversified exposure to hedge funds, which does not eliminate your exposure to fraud, but is intended to reduce the impact of fraudulent behavior.
Yeah, I just want to follow up on what Henry was saying a little bit about the fee issue that clearly the controls office is paying attention to with the SEC letters. A lot of this data, though, is based upon historical trends and historical relations. But I think everyone is seeing very creative ways in which fees constantly change as a result of the ability to do certain types of acts of offsets and other ways of creating dividends. So there's no real predictive way of suggesting that an asset class will continue to be in the same fee structure. We could rely upon past data, and additional fees could be going forward within these same types of asset classes. So I think the lack of transparency is really the issue here. And you can hear a lot from a lot of folks here and concerns.
And I want to go back to a statement that I made earlier, and that's that this is a strategic asset allocation. I think it's incumbent on all of us to make sure that you have the understanding of hedge funds that you need to say, going forward, we're going to maintain hedge funds, and we're not going to change our minds in 3 or 5 years and do something else, because that would be a costly change. So to the extent that we need to address those issues, we'd be happy to do so.
And I guess in terms of trustee education, this will continue in that regard. But and I asked this before in terms of hedge funds. But are there then other assets that have the same negative beta attributes needed to counterbalance?
I'm sorry, I'm not sure I understand what you mean by negative beta.
Diversification benefits, you mean?
Yeah, in terms of-
Relative to, let's say, stocks and...
or different index.
Right, something that provides diversification.
For that, you had a table that showed
Right.
negative. You showed hedge funds don't go down as much as when everything is going down, double digit hedge funds will go down by half of that. When everything goes up, hedge funds go up half of that. So it's not what has that kind of very few negative betas out there, and this seems to be one of the ones that are more pronounced.
You're right. There are very few asset classes that have the combination of strong levels of diversification with reasonably high returns. So you can go to short-term fixed income and get terrific diversification through your equity portfolio. But you're going to earn at this point fractions of a percentage point in return. So other diversification is out there. Hedge funds tend to provide a combination of that diversification with higher returns than most other asset classes. Can you think of another asset class that would be comparable?
No, well, commodities will provide a lot of diversification, but the expected return is about zero.
Terrible, yeah.
And a lot of volatility.
Right.
A great deal of volatility. So
There's not many that have the benefits that hedge funds provide in diversification area.
It depends a lot on how you structure the hedge fund portfolio. If you structure it to emphasize the diversification properties as we did, and having a very low net exposure to the markets, you get the maximum diversification properties of hedge funds. And it's kind of a classic case of the correlation charts that he showed a couple of slides ago. We have similar levels of expected return over long periods of time, but the returns present themselves at different times. And we've been experiencing that recently when the markets, public markets have been going straight up and hedge funds have not been going straight up because they're uncorrelated. And so it does present a very unusual group of exposures because they're big diversification benefits without big reductions in expected return. It makes them pretty unique.
It's not the case here, but you could construct a hedge fund portfolio that actually has a very high beta
Yeah.
to the equity markets. Not different than what Scott's saying in terms of what
Yeah.
has been constructed here, but you could make it something that's very highly correlated and high
But,
beta.
I can't assume that ours are behaving the way that Rock is showing.
Yeah,
I can't assume that, or,
In some ways even better because these guys would be having it's a general index, right, of hedge funds across the universe. The general, I saw Neil walking around here, but the net market exposure for a hedge fund portfolio is lower than the average, which would make the diversification properties even better. You might suffer a little bit of expected return, but you would certainly benefit from diversification because you don't have long-only exposure to the market. You have longs and shorts, and you're profiting from the extra value that's created by the hedge fund manager. It may have, in fact, often has nothing to do with the movements that are going on in the overall market.
We gave you a question.
Yeah, just raising into the point. We as a board adopted an investment strategy, right? A principal strategy. How do you account for the lack of transparency, right? When you assume these hedge funds are following that strategy, but they're not required to be transparent about it, right? I mean, how do you balance that?
So the transparency of holdings, real-time transparency of holdings is a challenge in this asset class. But it's a longer discussion as to why do we have to have that challenge. I can tell you that we're always endeavoring to improve transparency and evaluate the cost of opaqueness when we look at the particular strategies. Not all hedge funds are equal. Some have a lot of transparency. Some allow you a very good look at the characteristics of behavior of the portfolio. So they may show you the characteristics, the risk characteristics of the portfolio and the behavioral characteristics of the portfolio in almost real time. But you just don't know the individual names in the portfolio. It's the characteristics that are more important to us in terms of understanding whether the hedge fund manager is staying within the lines that they promised us in terms of the overall portfolio. What's the net exposure? What kind of drawdowns are we seeing? These are all things that Neil and his team and the team at Oxia measures very carefully to make sure that what we think we've got is indeed what we have. And when we see behavior different than that, that's when we call and make lots of questions. But there's no doubt about the fact that it would be better and easier to monitor if there's complete transparency.
I follow up to this. With hedge funds, say with the equity hedge fund, would it not be maybe injurious for us to know where they're looking to short? And that if that information were out there, it might actually damage the product?
Yeah, particularly for large hedge funds, there's a reason that they don't want to show their book because it could harm their ability to trade, particularly if they're beginning to unwind or put on a position. The frequent disclosure of positions could telegraph to everyone else. And so while it would be good for monitoring purposes for us to have that information, if that information is out there in the public domain, it could hurt our ability to add value because the market can see the hedge fund coming. And so this is why these guys are very secretive.
Okay. There are a broad range of things out there called hedge funds. In fact, one might question what makes them all a single asset class. My question for you is, in doing these computations, what is your universe of hedge funds from which you're looking at when you're estimating return, volatility, et cetera?
And to answer that question, I would like to turn to slide 40, which can make a variety of
And that's color-coded.
a little bit challenging to interpret, but what each column represents is a given calendar year, and the predominant hedge funds, or hedge fund strategies that are incorporated in, the broad indices. And so the intention of this slide was to show how different hedge fund strategies diversify one another. But I'll use it for this purpose just to show that there are a range of hedge funds that are incorporated in the benchmarks that we use to come up with a general hedge fund expectation. And so we are using a very diversified exposure to these types of strategies which are listed here. The purpose being is to not tell you that you should be invested in 4.35% hedge funds. I think what we're trying to get at is that is the appropriate allocation to hedge funds 4 to 6, 6 to 8, 1 to 2. It's a more general take on what a hedge fund exposure weight should be. As you point out, and if you just look at the returns from top to bottom, how diversified these are, to say that, talk about hedge funds as a homogeneous asset class is a mistake. So we do our best to kind of aggregate things up, to give you a sense as to what that weight should be, and then leave the implementation to be.
And also, in our discussions with BAM coming up in the next few weeks, what we have done for other clients sometimes is to create customized projections based on their portfolio of hedge funds versus what a broadly diversified portfolio would be. So we will talk with Neil and Scott about, do our projections represent what your portfolio looks like?
I think we'll get into this with two asset groups. I hesitate to call hedge funds an asset class for similar reasons that have been mentioned. But both in hedge funds, where, for instance, you look at the correlation on page 39 of the HFRI composite with the U.S. market, I think you'll find that from the stuff that you see from Axia, that our hedge fund portfolio's got different correlation properties. Is one of the things we see. Also in the infrastructure area, although we only have a few investments, what we're trying to achieve there is different than the public infrastructure that's listed here. So one of the things we'll be careful of when we go through the discussion is making sure that the components of asset allocation that these guys are studying are similar to the pieces that we're using. And we'll try to resolve any issues. And we're meeting with all the consultants at the same time to try to resolve all of these so that we can, this is for the mayor's office, so that we can present them in a consistent way across all 5 boards.
Any other questions?
Okay, Mr. Chairman, in the interest of time, can I just cover the last 2 slides? Just because I wanted to give you a sense of what you have to look forward to, at least a small view of what you have to look forward to in the asset allocation process. As Bud mentioned before, we take into account, and we've discussed, we take into account the basket clause when we do the asset allocation. We're not big believers in the basket clause, as you can see in some of the sub-bullet points, but we do take it into account. The purpose of the study is threefold, and you shouldn't be surprised at any of these sub-bullet points there. We're looking to make a 7% rate of return. We're looking to make that 7% rate of return at the minimum level of risk and in compliance with the basket clause. Generally, we start out, as was pointed out earlier, with an efficient frontier with optimal asset mixes that are unconstrained, and the last time that we did this is on slide 43, which was earlier this year, wasn't it?
Yeah, we just did it recently.
Yeah, so this is actually reasonably up to date, and you can see that your target mix, and this actually, I guess, addresses one of the earlier questions. The target mix right now, we have an expected rate of return of right on 7%, with about a 14.5% standard deviation. as the portfolio is currently constructed, and then as you look at the optimal asset mixes 1 through 4 on the right-hand side, we would look at asset mixes that are more conservative, earn less return but have less risk, and more aggressive, earn more return but have more risk relative to your existing portfolio, as well as mix 3, which has the same expected rate of return, and in a totally unconstrained environment, what that portfolio might look like. That's what mix 3 is. So less in fixed income, more in international equity, and when we're not constrained by the basket clause, and you can look at the other differences down that column. But these are the types of exhibits you would expect to see in terms of introducing alternative portfolios for your review. And then the way that we would review those is, as we discussed before, the range of return types of graphs over different periods.
Any questions? Dave?
So, not to detract from the rest of the content of these two slides, just to dwell again on one point which Scott already mentioned. Right? My understanding from this is that the constraints imposed by New York State law originally intended to reduce the risk in a portfolio, in fact, increase the risk. Is that correct?
That is our opinion.
For any given level of return.
For
Yeah.
any given level of return. Thank you.
Yeah, I mean, when you constrain it, you'll be able to see it. We'll do an optimal frontier, efficient frontier, unconstrained, and then with the basket clause, and you can see it's suboptimal along the continuum. And the difference, much like the chart that we showed before, is the cost of the basket clause, and there's a definite theoretical cost of the basket clause. Interestingly, though, we did an analysis of some of the incremental changes that were proposed for the basket clause, and they're too incremental to make much of a difference.
We've got a lot of work to do, right? So, thank you for your presentation.
Thank you.
Okay, Mr. Chairman, that concludes our public session remarks for
We
today.
have a motion to exit public session and go into executive session.
Motion.
All right. You set,
Second.
all right. All in favor?